I'm really delighted to introduce our second academic research panel now, which will be moderated by Professor Hanna Halaburda. And Professor Halaburda is a professor here in NYU's Technology Operations and Statistics Department, and she specializes in both platform economics and also blockchain. In addition, on her resume is that she's worked on Project Jasper with the Bank of Canada, which was one of the pioneering CBDC initiatives. So we heard about DeFi lending this morning, and now we're going to hear about DeFi trading, which has become one of the most ubiquitous and intriguing applications in the DeFi marketplace. So I'm going to turn it over to Professor Halaburda, who will introduce her panel. And for those of you with interest in asking questions, you can put the questions in the Q&A box at the bottom of the page, and we'll have a few minutes at the end for those questions. Take it away, Hanna.
Thank you, Kathleen, for the introduction. And let me start this panel with a simple observation. So DeFi applications focus on the novel technology that allows for automation and removing human from many of the procedures. And at the same time, opportunities of DeFi applications and risks of DeFi applications crucially depend on the combination of the technology and human element. So in this session, we're going to focus on how DeFi technology is used, abused, and underused by humans, and specifically in trading, in learning, and in staking in DeFi. The three presenters of our session, Alfred, Lehar, Sarit, Markovich, and Cong, come from diverse research backgrounds, from finance, from management, and from strategy. They all have been researching blockchain for many years from different perspectives to give us a fuller picture. So with that, I want to invite the first speaker, Alfred Lehar, who is a professor of finance at the University of Calgary, to talk about DeFi trading.
Well, thank you so much, Hanna, and thank you so much for the organizers to have our paper on the program. So this is joint work with Christine Pallur from UC Berkeley, and we are I want to talk today about decentralized exchanges. So the question is, how do these DeFi exchanges that we see emerging on these blockchains compare to traditional exchanges? And the idea is that on a traditional exchange, this is always operating as some kind of version of a limit order book. And so far, the consensus in the finance community has been that this is the best way to provide liquidity to a market. And the key assumption that underlies this conclusion is that market makers are perfectly competitive and they obtain zero profit. Well, this is not totally true. We see a lot of investments into high-frequency trading technology. People pay a lot to co-locate with the exchange computer and things like that. So it might be that these liquidity providers on traditional exchanges try to carve out some kind of competitive niche and extract rents, which makes this inefficient. So we want to look at this new form of liquidity provision that we see in DeFi in a more general setting. Not only how does it work in DeFi, but also how does it work in general to trade assets, and could this be an alternative trading mechanism? So we find that liquidity pools can actually dominate limit order markets in some cases when there is a lot of uninformed trading, when prices don't move that much, and when the incentives to invest in this high frequency trading are very strong. To me, this was personally a little bit surprising. I started out this research agenda thinking, well, we're going to show that this is not going to work, but surprisingly, it does pretty well. Actually, we find that this liquidity pools track limit order market prices very well. Traders can have lower price impact and also have a lower variation in price impact, which might be very important for institutional investors. So in this kind of, we have a little theory model to motivate our findings. So usually we have in these models two types of traders: liquidity traders who trade for some exogenous reason, like you want to buy a consumer good or something like this. And we have arbitrageurs in our model who either trade if there's some fundamental movement in price or to exploit some imbalance in markets. In the traditional limit order market, we have these competitive liquidity providers. You make money on the bid-ask spread when you sell to these liquidity traders, and you lose when you trade with these arbitrageurs. And so in equilibrium, you balance off the gains with these losses. Our model is a slight extension to this, that we allow the investment is high-frequency trading technology, which is socially wasteful and costly, but you can learn something about whether an institutional trader is placing a large order and then trade on this information faster than others and make some extra money out of this. So we compare this kind of setup of the limit order market with decentralized exchange, which is modeled on Uniswap, which is the largest DeFi facility. So Uniswap trades over several $1 billion a day, and the posted liquidity is about $7.5 billion. So Uniswap itself has tens of thousands of liquidity pools, and anybody can be a liquidity provider on Uniswap. I'm a liquidity provider on Uniswap. I could not be a liquidity provider in the New York Stock Exchange, but I am a Uniswap liquidity provider. It's pretty easy. You provide some inventory to that pool. How do you trade with that? You send some token A to a smart contract, and the smart contract sends you back some amount of token B. So this follows from a mathematical function here, and which is called the bonding curve. So suppose that our liquidity pool starts out here with some balance of tokens and some balance of ETH here, T0, E0. So we're at this point, and then we have this pre-specified bonding curve that goes through our point where we are at the moment. And if somebody sends some tokens to that liquidity pool, then the token balance of this pool goes up. And how much ETH does the smart contract send back to the trader? Well, we can solve that graphically. We know that the new point after the trade has to be again on this bonding curve. And so the difference here on the y-axis that we see between E0 and E1 is how much ETH the smart contract sends back. So it's a pretty mechanical and simple thing, but it works surprisingly well. So what is the economics that we try to put on top of this simple model? So one thing we have to observe is that these liquidity providers, the people who provide the inventory that users can trade against, they earn a certain fee per trade. So what happens if there is a liquidity trader and just somebody buys and sells some token, but there's no change in the true price of the token? Well, let's go back to this graph. We see that this token, the pool moves from the red dot to the green, to the blue dot. A little bit colorblind here. So, and then what happens is an arbitrageur arrives at the market and sees, hey, this pool is out of balance, so let's push the price right back to where it was. So you trade again to the equilibrium price E0, T0. So you end up at the same spot where you started. As a liquidity provider, there's no harm done, but instead as a liquidity provider, you earn 2 times the fee, which is actually good for you. So this is a great event for the liquidity provider. What happens though if there is a change in the true price and the true price of the token moves now to E1, T1? The computer is, of course, the smart contract is not as smart as you would think, and of course doesn't know that the price really has changed. And so the liquidity pool quotes a stale price. And the arbitrageur will come and take advantage of this mispricing. The pool gets picked off. And so the liquidity providers in this case lose out because they have sold to the arbitrageur at a stale price and have not updated the price in the pool. So this determines, in a way, in this trade-off, determines the optimal pool size. So what these liquidity providers provide liquidity as long as the fee revenue is equal to the losses from quoting stale prices. Now, what is very nice is that this pool size actually affects the curvature of this bonding curve and thus the price impact. So if the pool is smaller, then we have a higher price impact. If the pool is larger, we have a lower price impact for trading in these markets. So we do see that these pools can be better than limit order markets because the investment in this high frequency trading technology is wasteful. It's not socially desirable. In the pool, these losses get mutualized. So in a way, you cannot be faster than any other liquidity providers. There's no benefit in canceling your orders quicker. So all the losses get mutualized amongst all the liquidity providers, and this provides a better way to provide more stable liquidity in the market. So in the paper, we go through the model and derive certain conditions, but I want to show you in the last kind of few minutes that I have some empirical facts. So we look at Uniswap V1 and V2 liquidity pools. There is currently version 3 out, but the time series is very short on that, so we cannot draw a lot of conclusions yet. But we have about 36,000 individual liquidity pools with about 47 million transactions. We have liquidity injections, about 1 million of them. We have a few withdrawals of liquidity, and we have a lot of token trades. So one of our theoretical predictions is that the pool size is decreasing when there is a lot of variation in the price. So we measure this with token volatility, price volatility, and we do find indeed that when a pool is more volatile, the pool is actually smaller. The other thing that our model predicts is that the pool size increases with uninformed trading, and we also find that here. So how do we say whether a trader was informed or not? Well, we just say there's so many news events a day, so anything that is trading beyond this trading that's based on these news events is extra trading, and that must be uninformed trading. And so we have here a positive relationship between volume and the number of trades and pool size in line with this prediction. The last item we do is probably the best measure of uninformed trading. This measures reversals. So this is exactly the situation I was pointing out before in the graph. A trader arrives, pushes the price out of equilibrium, and an arbitrageur comes and pushes the price right back to where it was before. We can see all these trading events on the blockchain, and we call those events a reversal, and we find that the more of these reversals we see, the larger is the size of the pool, which is consistent with more uninformed trading. What we also see is that liquidity provision is actually surprisingly stable. So you would think that in a lot of traditional financial markets, we see that liquidity orders, limit orders are posted and canceled. Actually, a lot of the limit orders are canceled in traditional markets like the New York Stock Exchange. But here we have very few liquidity withdrawals, only about 1% of the sample, and we have very few high frequency liquidity withdrawals. So in total, we only have 18 observations where somebody deposited and withdraws liquidity over $1,000 and within 5 blocks. So if somebody deposits liquidity, it's very stable. And the only events that we see where somebody adds and withdraws liquidity are where people try this out and say, hey, let's try out if this works and if we get our money back at the end. But for any large, significant amounts, we don't see that. And so here is an example of how stable liquidity provision is in these markets. So this is on May 19th, 21, the price of ETH against US dollars dropped by over 40%. So this is about twice the size of the 87 stock market crash. And we see the price on a high frequency basis here in this orange area. And the blue area, the blue line, shows you here how much liquidity was withdrawn from ETH US dollar liquidity pools over time. And that goes with the right axis here. And what we see is that, first of all, in total, very small amounts of liquidity were withdrawn. This was a major crash in the market, right? And only about 17% of liquidity was withdrawn. And a lot of the liquidity was withdrawn after the price hit bottom and was actually way back up here on the path to recovery. This is when some of the liquidity was withdrawn. So liquidity provision is very stable, and traders can trade in these markets even in times of crisis. We also look at the pricing error, which is this blue line here, and that goes with the right axis where you see the percentage pricing error, and pricing error is very small except for the very beginning here where you see wild swings in pricing errors. So we compare here Binance against Uniswap prices for tokens, and the reason why there is pricing differences between what would be a traditional exchange and these liquidity pools is that the liquidity pool was very small. You see pool size here on the left axis in a log scale, and that goes with the orange area. So once the liquidity pool hits a certain size, then this is very much able to track prices on a traditional exchange and limit order market like Binance. So here is one random day that I picked out of the sample, and we see prices in Binance in blue and orange in Uniswap, and these prices track pretty closely, even though this is no human involved. This is just a smart contract that's deployed on the blockchain and tracks the price on a traditional exchange pretty well, where there's a lot of human activity and a lot of traders are active. For institutional investors, this is probably the most interesting graph here. We look at price impact on Binance, which resembles more the traditional financial markets. And we see that, so that's the blue line, and we see that it is substantially higher than Uniswap, which are the other two lines, but also it's much more volatile. So we have days where price impact is pretty low for trading, but there's also days when price impact is pretty big. Versus Uniswap, the price impact is very low and also very stable over time. So this is really great for institutional investors who want to sell a larger amount. So investors realize this, and we do see that the price, that the trading volume on Uniswap, which is the orange line, really overtook the trading volume of Binance. So this is for the USDC ETH market. And so traders are using this. What is surprising to us is that trading volume is pretty correlated across the two markets. That was not something that was obvious to us or was expected. So to conclude, in this paper, we present some evidence on the efficiency of this new model of liquidity provision. We argue that liquidity providers in the limit order market have an incentive to invest in this wasteful technology versus in the liquidity pool, an automated market maker. These adverse selection costs from trading with informed traders are mutualized, so therefore the costs of posting liquidity are actually lower. We show you some examples that these liquidity pools track limit order markets very well and can actually dominate them as a trading venue. Specifically, these liquidity pools have lower price impact and lower variation in price impact than traditional financial markets. Okay, that was it. Thank you very much.
And thank you very much, Alfred. It's fascinating. I hope we're going to get a couple of minutes for questions after all the talks. Now let's move to the second speaker. Our second speaker is Sarit Markovich, a strategy professor at Northwestern.
Okay, you can hear me now, right?
Yes.
Okay, very good. I'm so happy to be here, and I am going to present a fun paper that I actually really enjoy presenting. It is called Information Processing Costs, Evidence from DeFi Market. It's joined with Don-Chi Hu and Valerie Zhang. And basically, when we're thinking about most financial markets, they are opaque, they exhibit asymmetric information. As a result, we know that regulators aim at transparency in the hope that this is going to increase market efficiency. However, this is going to work only if investors, traders actually really take advantage of the data that is publicly and freely available to them. And that is our motivating question. When available, do traders actually take advantage of all the freely and publicly available information? And when we think about blockchain-based market, when we think about DeFi, this is really represents a great opportunity to study this question. And specifically, we are looking at the decentralized lending protocol Maker to ask two questions. The first one is, do traders actually take advantage of publicly and freely available data? And we're measuring it by whether we see that they are using the information in order to follow what other traders are doing, successful traders. And if not, why? So what cost might be associated with publicly and freely available data? And I'm going to start with a preview of the results. So first, what we find is that the information is out there. So if we find that there is a cross-sectional persistence in returns, meaning that if you were previously outperforming the market, then you're more likely to also perform the market with your current loan. And then if you were previously liquidated, which is a failure, which means that you were not successful, then this is also going to increase the likelihood that your current loan is going to be liquidated. So the information is out there, and then the question is, okay, so do we see traders using it? And the answer is mostly not. And when you're trying to understand why, then we realize that, just like in traditional markets, when we're thinking about accounting costs, we still have accounting costs also here when we're thinking about awareness, integration, and acquisition costs. And that's going to be true both when we're thinking about looking at historical data and when we're looking at real-time following. So if I want to calculate, if I want to decide who I want to follow, then I'm going to use historical data, but I still need to calculate the returns. I still need to figure out who are going to be the ones that I want to follow. And that means that still the integration costs are going to be high. And then when we think about real-time data, it's really about monitoring and acquiring all these transaction data, and that's going to be costly as well. So let me tell you a little bit more about the Maker protocol. So the Maker protocol is really a set of smart contracts that are deployed on the Ethereum network, where basically you can deposit ETH, and in return you're going to get DAI, which is the native token of the Maker protocol, and it is pegged to the dollar. And then anyone who wants to take a loan can take a loan. So there are no background checks, there is no underwriting and so on. Instead, what we see that is happening is that loans are over-collateralized, meaning that specifically in the case of Maker, then the loan has to be over-collateralized in 150%, meaning that if you want to take a loan that is worth 2,000 USD, then you have to you have to lock in a smart contract if that is worth $3,000 at least. Okay, and then what we're going to see is that you are borrowing in DAI, that is like in dollars, but your collateral is in ETH, and that means that the value of your collateral can go up and down. And specifically, going down is bad because that means that at some point you might be under collateralized. And then if you are under collateralized, then we're going to have liquidation. Your account is going to be liquidated, and you're going to be charged a 13% fee. So we have data on all of the transactions on Maker starting December 2017 till May of 2020. And we're limiting ourselves only to traders that have at least 2 loans and borrowed at least $1. So at the end of the day, we have a pretty large sample size. And then one question that you're probably asking yourself is, I'm talking about loans. Why am I thinking about it as an investment strategy? Why am I thinking about it as trading? And the reason that we're thinking about it as investment strategy is that when we go back to Maker's early days, this is really the early days of DeFi. And you didn't have Uniswap back then. And what investors mostly used the Maker protocol for is really for leverage trading. So to leverage themselves and margin trading, where basically the idea, and this is an example of a loan that we see. The idea is that you put this collateral, and then you borrow a loan, and then you're taking the money that you borrowed and maybe even adding some to put some more collateral so you can borrow some more. And then you're putting this money that you borrowed in order to borrow some more. And then you're putting this money that you borrowed, and you keep kind of like leveraging yourself up to a certain point, obviously, because again, you always need to make sure that you are over collateralized and at 150%. So since this is what we see, and we checked and we see that this is what traders were using the Maker protocol back then we can really think about it as an investment strategy where if I believe that the price of ETH is going to go up, I want to expose myself as much as I can to ETH. And this is going to be, the Maker protocol is going to allow me to do that by really using this margin trading. So how do we calculate the return on a loan or return on investment? Well, basically what we do is that we're taking the value of your loan at the end of a cycle. So we're looking at loan cycles where you took a loan and you completely repaid it. And then we're looking at everything that you've done in between, the additional transactions that you have in between, and then looking at the value at the end of the loan minus the value at the beginning, or so what you put throughout the entire loan cycle, and then dividing it by what you put throughout the entire loan cycle. So going back to our example, what we see is that the collateral is pretty much what we know that our investor actually put into the cash that the investor actually put into the loan. And if you sum it up, you get 51.81. At the end of the day, at the end of the loan cycle, the value of the loan was actually 52.08. So we take the difference and then divide by how much you invested. So for this example, the return on the loan was 0.5%. So looking at our results, as I said, the first thing that we're looking for is, are we going to be able to see, is there any kind of persistence in terms of performance? And we do find cross-sectional persistence in terms of performance, both in terms of those who are doing better than others and in terms of those that are doing not as well as others. So we're going to think about them as the winners and the losers. So yeah, there is definitely consistency. If your past loan outperformed other loans, then your current loan is going to be more likely to outperform other loans as well. And if your past loan was liquidated, then your current loan is going to be also more likely to be liquidated. So again, the information is out there. Do traders actually use this information? Do they follow the winners or avoid the losers, right? There are two ways for you to go. So in order to look at that, we first have to define our following measure. And we're defining following by a trader who is following another focal trader. And that trader has to follow at least 50% of the transactions that the focal trader made. And it has to be in the same direction, meaning that if the focal trader puts some more collateral, then he's also putting in some more collateral. If he repaid it, then the follower is also repaying. So you have to follow at least 50% of the transactions, and this has to be done within 15 minutes after the original transaction. So looking at the data, do traders really follow others? As I said, mostly no. We find no relationship between returns and following. And obviously, we want to understand why. So we want to understand what are the costs associated with following. And following actually is going to have two steps, right? The first one is to identify who do I want to follow. And that's going to be based on historical data, right? I want to identify who I want to follow, and I want to identify who I want to avoid. So the winners and the losers. And that is going to be based on historical data. And then I'm going to really follow them in real time. Now, acquiring historical information on the blockchain is actually pretty easy. And also awareness is not going to be really relevant. So when we're thinking about the costs that are associated with using historical data, it is really about integration costs. It's really about calculating these returns. So how do we test for integration costs? What we do is we're looking at a launch of a website that provided very clear and easy information about liquidations. So if you wanted to see which wallets were liquidated, then it's very easy for you to see. And we're trying to see whether once this information was available and accessible and easy to digest, whether we see that traders are avoiding the losers. And indeed, this is exactly what we find. So this is going to be, we're really splitting our data to before the introduction of the website and after. And if we're looking at before the introduction of the website, there is no one is trying to avoid the losers, but we definitely see that they are avoiding the losers after the introduction of the website. However, it is still the case that they're not following the winners, and that's because there are still high integration costs. So calculating the returns is still something that you need to do, and it's still complex even when you have the data. So moving to the second stage, really thinking about, okay, so what are the costs that are associated with using real-time data, really kind of like following others. And it's really going to be about monitoring and acquiring real-time data, which is going to be costly and, specifically if done manually. And then typically it is going to require some kind of investment in automating the process, which means that there are some barriers to entry to try even to start doing that. And then once you do have the data, or once you're automating that, then it is still going to be the case that there are going to be integration costs in terms of smart contracts. So if I'm following the smart contracts, they're going to be the typical smart contracts that Maker is using, but there are also smart contracts that other sophisticated traders are using. And then if I want to follow them, I'm going to incur some additional costs. So we're looking at whether, when we're looking at those traders that are interacting with more smart contracts, are they going to be less likely to be followed? And that's exactly what we're finding. We're finding that those that are interacting with more smart contracts are less likely to be followed, and and that's also true for the interaction with the winners. So even winners that are interacting with more smart contracts are not going to be followed as much as others. We're actually also trying and doing the same test for durations and number of transactions, and we do get similar results where it's really once you're probably automating the system, then it's mostly going to be about integration costs rather than the awareness and acquisition costs. So I am going to conclude by actually really thinking about policy implications. And I think that there are very important policy implications to the paper where first and foremost, it really transparency by itself is not enough. Information should be easy to collect and to process, and policymakers should aim at the provision of easy to access and digestible information rather than transparency per se. That's it. Thank you very much.
Thank you very much, Sarit, for this excellent presentation. And it's really interesting to see how transparency it's not enough. It's not enough to provide technology. Our limited human processing powers of absorbing this information that comes from technology may be a problem in harnessing the advantages of it. Thank you. So with that, we're going to move to the final speaker of our session, Will Cong, who is a professor of management at Cornell University, will talk to us about staking in DeFi applications. Take it away, Will.
Well, thank you very much, Hanna. Thank you for having the paper on the program. So this is the academic session. I'm going to show some heavy formulae in the slides. What I'm going to talk about, the title has changed slightly, is primarily about staking. We know layer 1 staking for consensus generation through, proof of stake and the like. And there's also DeFi staking. Sometimes we're using the word locking. We've seen examples actually in MakerDAO and also in Uniswap that our previous speakers, Alfred and Sarit, have also touched on. Those are forms of DeFi protocols that often have locking or staking programs ongoing. What we care about is what are the token pricing implications of staking in aggregate, and how is this related to international finance? If we really think about these tokens as currencies or even commodities, right? Would there be a carry trade that we know to be existent for in the forex market? So this is John work with Zhiheng and Ke, who are at Tsinghua University. Let me just move to the next slides. I don't have to do too much introduction on the blockchain and DeFi innovations. I talk about that in several other papers I've worked on. Safe to say there are many applications, but a lot of these applications, unless it's a app currently in China, it typically involves some form of token. So we need to talk about the categories and functions of tokens. What the model I'm going to show you is going to apply to are really general payment tokens and platform tokens. Basically, these tokens are used as means of payment, typically on a platform providing specific functions. If we talk about Ethereum, that'll be smart contracting. If we talk about Definity, that'll be a decentralized computation. So in some earlier theoretical work, my co-authors and I have introduced dynamic token valuation models and how tokens are used to accelerate platform growth, and how do we think about the monetary policy of issuing tokens within a platform. And on the industry side, I've worked with Definity, Findora, Chainlink, and so on regarding the token design or blockchain economics. So some of these, even though this is more on the theory side, some of these are actually quite applicable in the industry, in practice. But what is especially interesting over the past 2 years, when we started the project, it was 2 years ago. We didn't anticipate this too much, but decentralized finance, DeFi, has been on the rise. Cam has and co-authors have a very good book on that. So we've seen many DeFi innovations, whether it's a stable coin, lending, yield farming, liquidity pool, insurance pool. It's estimated by CoinMarketCap this morning that total DeFi market cap is over 120 billions. So what we're trying to do is, given that staking is a very common phenomenon, both for layer one consensus generation and for DeFi innovations, we want to understand the asset pricing implications. And just methodology-wise, this is one of the early applications of mean field games that have been applied to mostly macro settings, talking about wealth inequality, but there are many applications in the FinTech space or cryptocurrency space. Just a little bit more institutional background. I've already talked about how proof of stake is a form of staking, right, where you essentially lock up your tokens in order to generate consensus records on-chain. There are many more examples. The market size for this is even bigger. Over 1 year window from October 2020 to 21, this has increased from $21 billion to over $300 billion. In terms of DeFi protocols, at least in the data we observed, there are over 60 of them. And the yield, right? When you lock up the token, you actually get almost like an interest that you get from depositing money in banks, is ranging from 8% to 15%, depending on how we take the average, weighted versus equal, market weighted versus equal weighted, which is pretty high in the space. And I don't have to mention all the examples. Of course, the rewards that you get in this space, it typically comes from subsidy of the protocol, the team. Sometimes it's coming from fees collected. If you're providing liquidity, for example, people pay transaction fee that would go to what's going to come out as your yield, right? The reward. Of course, there are events of slashing where your stake is taken if you are not generating the consensus properly, or there's some issue with the service that you're trying to provide through staking. The informational environment for staking is quite transparent. You actually see what the program's plan is for, in terms of subsidy, in terms of new emissions within the space, and also in terms of how fees are going to be translated into the yield that's paid out. And there are also third-party aggregators such as stakingrewards.com, earncryptointerest.com, where you can find this information. So in terms of token stake, in terms of total value locked, these are all quite transparent metrics that one can see. So I really want to compare this to, bank deposit. We are depositing our tokens in these different cryptocurrency platforms or DeFi protocols. We're earning an interest that's in the form of staking reward. If there's no arbitrage, I think it's natural to think about what should be the relationship between the yield rate across these different tokens and their kind of token value appreciation, right? Just making an analogy to different currencies. So first we set up a model to study that. You don't have to worry too much about details. I just want to provide the basic elements. It's a continuous time model where a native token is used on the platform. We're going to use the numeraire consumption goods as a numeraire. There is a exogenous quantity called platform productivity. It's essentially how innovative the platform is, how active economic activities are. We assume it follows a geometric Brownian motion. You can further endogenize that through decentralized contribution, through monetary policy that's active on the platform. We've done that in previous studies, but here, for simplicity, it's just going to evolve exogenously. There's a unit measure of agents. Each one it's characterized by the total wealth the person is carrying. The agent has to decide how much wealth to allocate on-chain for transactions, right? That's XT. How much is going to allocate on-chain for staking? That's lowercase LT. And how much I'm going to hold in terms of numeraire. And for simplicity, you can think about that as fiat US dollar, right? For consumption, that's NT. And how much am I going to actually consume at time T? That's the consumption YT, right? These are all denoted in numeraire. I'm not talking about number of tokens, right? I'm talking about kind of in terms of consumption value, how much that is. If I use the token for transaction, I get a convenience yield, which is following the earlier framework, where the more I put on-chain, the higher convenience yield I get. And there's a type parameter given by this U function. It's essentially characterized by my wealth, because that's the only heterogeneity across the agents in the system. And AT is the productivity of the platform. If the platform is more productive, there's greater convenience we can derive. And for holding the numeraire, just following the literature of international finance, I'm going to introduce a consumption convenience function for holding the numeraire as well, but it's not too crucial. In terms of the reward process, part of that is coming from pre-announced new emission-based reward. Part of that could be collections from fees, and we can introduce some random component to that just because it's hard to predict. Tau t could be a mean zero or a positive mean random variable, and Qt is the number of tokens in circulation, basically the token supply in the system. And the reward rate is simply the aggregate reward divided by the number of tokens staked. So that's my reward rate. We can assume there's some slashing cost, just the risk of losing something, and that's given by the CT rate. Token price is going to be fully endogenous. Here, the drift mu t and sigma t are all endogenous and could be time varying. And one key variable I want to introduce is the staking ratio. That's something people haven't paid much attention to. It's very important. It's the aggregate number of tokens staked divided by the total number of tokens in circulation. So this capital theta is quite important. So I'll skip the details of solving this system. It basically involves a optimal control problem for each individual. And you also need to keep track of the whole distribution of the individual wealth. So it's essentially a mean field game. And the equilibrium involves individuals' control and the law of motion for the system states, which are the price, the aggregate staking ratio, the wealth distribution, and everyone is optimizing his own problem, and the reward rate has to solve the fixed point problem, right? Individuals take the reward rate as given, just like we take the bank interest rate as given. But our aggregate deposit is going to affect how banks adjust the interest rate. So that's how we can solve it. There are a few predictions from the model, but I think in the interest of time, let me just talk about these predictions when we look at the data. Safe to say we can derive a dynamic token pricing formula that's very similar to Black-Scholes formula with a few differences that I'm happy to talk about. And here I'm just showing you how when reward rate increases, the staking ratio both for individual and aggregate would increase, and that would allow us to solve for the equilibrium outcome. And this is the relationship between staking ratio and expected price appreciation. Basically, if you have a higher aggregate staking ratio, the expected price appreciation is going to be higher. Okay, so let's look at some data. We get data from stakingrewards.com, 30 stakeable tokens that includes both POS-based protocols and some on-chain DeFi projects, July 2018 to August 2020. That's what we have. A quick sanity check shows that when the reward rate is higher, when the staking ratio is higher, the reward rate is lower, right? Because most of these programs are fixing the total reward amount, fixing the quantity. So if more people are staking, then per token's yield is going to be lower. Of course, you can talk about designs that fix the yield. It's rarer, but there are some examples. In the cross-section, when the staking reward is higher, the aggregate staking ratio is higher, right? It's just more attractive. That's not too surprising. And the aggregate staking ratio really positively predicts token price returns. And the idea is really, when tokens are more staked in terms of fraction, that means they are moving, at least the velocity is slower, it's being locked up. Less tokens are in the ecosystem to mediate all transactions. So for the same amount of business transactions, each token has to be able to clear more transactions. So token price has to go up. One more prediction from the model is...
Will, you're running out of time, so we have 1 minute to wrap up.
Okay, yeah. Let me just quickly wrap up here. Uncovered interest rate is violated because the yield of the interest has to cover the loss of convenience for holding the token for transactions on the platform. You can construct carry trade strategies. You can use carry to predict asset returns. This is just cumulative return for the carry trade. This is a table showing how carry can help predict 7-day to 1 week to 2 week returns in the token in particular. So I'm going to stop here. And one thing I want to highlight is really this aggregate staking ratio. And it's different from total value locked. Total value locked, it involves non-native tokens and other forms of tokens as well. But staking ratio is really the native token as compared to the total number of native tokens in circulation. So thank you very much.
Thank you, Will. So now I would like maybe all three of the speakers to be present, and we have a couple of very cool questions in Q&A. But before we get to them, I wanted to ask Alfred a question. You're showing that liquidity provision in DeFi is more stable, and it comes from the fact that there's fewer withdrawals of liquidity. Can you tell us what is driving this different behavior of liquidity providers in DeFi versus standard financial services?
I think one thing we observed is that the fee revenue during this kind of flash crash episode that I showed was really, really high. So in a way, liquidity providers are compensated at a time when their liquidity is really needed. And I think that's one thing. And the second thing is really this kind of mutualization aspect, that it is not really worthwhile to run and withdraw your liquidity quicker than somebody else, the gains from doing that are not as big as if you get out of the market in a traditional setup and run away and let other people provide liquidity. So I think those are the two factors that contribute to the stability and liquidity provision that we see.
Which is interesting, because it's not that there are different players, but there are just different incentives provided by the technology.
Yes, I think so. Yeah.
Okay. Thank you. So, Sarit, there was an interesting question in Q&A, and I thought maybe you can address kind of to the whole audience about the identity of your traders, right? So to what extent we can talk about individual traders in a permissionless environment?
Yeah, obviously this is very challenging, and we tried different ways, because we know that there are kind of like lots of algorithms to try and tie accounts together. But at the end of the day, we are actually just using the user wallet. And what we did was we looked and we see that actually people are on the blockchain, using the same wallet for years. And then also we feel that in a way this is just kind of adding noise to our data and just making it hard for us to find results. So if we're finding results, then that means that the data is there. But that's the best we can do, and I know that this is a limitation.
Mm-hmm. But still, I mean, this is again limitation of technology. As long as we have permissionless systems which afford. Yeah, exactly. Thank you. And Will, we also had one question to you about the whether staking interest is calculated as you calculated is normalized by volatility risk. I think it's also an important point, because staking seems to be very stable, but the value of the currency in which you are staking is very volatile. So do you account for that?
Yeah. So in a sense, in the theoretical framework, is accounted for in the sense that the agents could be risk averse, and the volatility part is coming from the fundamental volatility of productivity of the platform, the AT. Whether that AT incorporates, for example, speculation, right, in the secondary market and behavioral issues, sentiments, that's to be debated. So in a sense, if you want to incorporate pure secondary market volatility, you can introduce that term, but it's currently not in the formulation. So this is more of a fundamental pricing model.
Okay. Thank you. So with that, we reached the end of our session. I would like to thank all three of the presenters for interesting presentations and for a lot of food for thought in terms of where the DeFi applications are going and how people are using it or misusing it or underusing it in terms of getting information, for example. So thank you very much, all of you. And let me pass it on to Kathleen. Thanks.
Thank you, Professor Halaburda, and thank you, panelists. Those super interesting examples of really frontiers of finance research and really interesting comparisons between TradFi markets and DeFi ones around some very important topics. So thank you very much.